Gold. Why the safe haven isn't acting safe. Gold has long been considered one of the safest places to put money during uncertain times. Whenever wars break out, economies slow down, or markets become unstable, investors traditionally rush to gold. The reason is simple. Gold is a physical asset. It cannot be printed like currency, and it tends to hold its value even when everything else becomes unpredictable. Historically, this pattern has played out again and again. During the oil crisis of the 1970s, gold prices surged as global markets were shaken. In the 2008 financial crisis, gold saw a strong rally as investors lost confidence in banks and financial systems. Even in the early stages of the Russia-Ukraine war in 2022, gold prices climbed as fear spread across global markets. In each of these moments, gold acted exactly as expected, a safe haven. But the ongoing 2026 Iran war is telling a different story. Before the conflict escalated, gold was already trading at around $4,900 to $5,000 per ounce, reflecting global uncertainty. When the war began, prices briefly surged to around $5,100 to $5,200 per ounce as investors rushed in. But that didn't last. Instead of continuing upward, gold reversed sharply. In recent weeks, prices have fallen back to roughly $4,500 to $5,100 per ounce, marking one of the most volatile periods and even one of the worst weekly declines in years. So why is gold behaving differently this time? The biggest reason lies in the strength of the US dollar. In today's global financial systems, the dollar itself is seen as a safe haven. During the Iran war, investors have been moving their money into the dollar instead of gold. Because gold is priced in dollars, a strong dollar makes gold more expensive for buyers in other countries, which reduces demand and pushes prices down. Another important factor is interest rates. Gold does not generate income. It doesn't pay interest like bonds or saving accounts. When interest rates are high, investors prefer assets that give returns. The Iran war has increased fears of inflation, and central banks are now expected to keep interest rates higher for longer. This has made gold levels attractive compared to other options. At the same time, many investors are choosing liquidity over tradition. Instead of parking money in gold, they are holding cash or investing in short-term government bonds, which are easier to access quickly in uncertain situations. This reflects a shift in how modern markets respond to crises. Gold is no longer the only safe choice. There is also the factor of profit-taking. Gold has already seen gains leading up to the conflict, so when the war intensified, many investors chose to sell and lock in their profits. This added further downward pressure on prices. The Iran war has pushed oil prices higher, which usually supports gold. But rising inflation also leads to higher interest rates, which, as mentioned earlier, weakens gold. As a result, gold is being pulled in two opposite directions at the same time. As of now, gold prices remain volatile rather than steadily rising. After briefly climbing at the onset of the war, prices have fluctuated and even dropped significantly from their recent highs. This reflects a market that is uncertain and constantly reacting to new developments in the conflict rather than following traditional patterns. What this shows is that while gold is still important, its role as a safe haven is evolving. In today's world, investors have more choices and global finance is far more interconnected than it was decades ago. The 2026 Iran war highlights that gold no longer automatically rises in times of crisis. Instead, it competes with assets like the US dollar and government bonds. In simple terms, gold is still a safe haven, but it's no longer the only one.